What if I told you that the state of California is currently drafting a legal trap that could keep your bank account hostage for a decade after you move? They call it the exit tax, but let's call it what it really is. A financial prison sentence. If you think you can just rent a U-Haul and drive to Texas to escape the madness, you are dangerously mistaken. The deadline to get out with your wealth intact is approaching faster than you think, and if you miss it, you could be paying Sacramento for years to come. Welcome back to Tax Hack Pro. We expose the financial threats that the mainstream news ignores so you can protect your hard-earned money. Before we break down the 10 reasons why you need to accelerate your escape plan immediately, make sure you smash that subscribe button. We are tracking this legislation daily, and you do not want to miss our next update. More than 800,000 people have fled California in the last 2 years. That is not a migration, that is an evacuation. They are running from record-high property taxes, an insane cost of living, and a regulatory environment that treats success like a crime. But the state government has noticed the exodus, and they are not planning to let their cash cows leave without one final, decade-long squeeze. In this video, we are going to walk you through exactly why February 2026 is the date you need to circle in red on your calendar. We will explain how the proposed wealth tax works, how it targets unrealized gains, and why even remote workers in Bali could get a tax bill from the Franchise Tax Board. Let's dive into the data. Reason number 1, the wealth tax is no longer a conspiracy theory. For years, people laughed off the idea of a wealth tax in America. They said it was unconstitutional. They said it would never pass. Well, the laughter has stopped. California legislators are aggressively pushing Assembly Bill 259 and ACA 3, which would impose an annual tax on your worldwide net worth. This isn't an income tax. This is a tax on what you own. If you have built a business, invested in real estate, or saved diligently in the stock market, the state wants a piece of the principal. The initial proposal targets those with a net worth over $50 million, but here is the tax hack reality check. Taxes always start at the top and trickle down. The income tax started as a tax on the ultra-rich, and now it hits everyone. If this infrastructure gets built, the threshold will drop. It will hit the $10 million entrepreneur, then the $5 million retiree, and eventually the upper middle class. The scariest part, it taxes unrealized gains. This means if your house goes up in value or your stocks appreciate, you owe tax on that paper profit, even if you haven't sold the asset. You haven't seen a dime of cash, but you have to write a check to the state. Where do you get the cash to pay the tax? You might have to sell the asset just to pay the bill. It creates a liquidation cycle that destroys wealth accumulation. Reason number 2, the 10-year exit tail. This is the provision that has estate planning attorneys losing sleep. The proposed legislation includes a look-back period. If you leave California, the state wants to continue taxing your wealth for up to 10 years based on the idea that your wealth was accumulated while you were a resident. Imagine moving to Florida in 2026 to retire. You sell your business in 2030. Under this proposal, California could reach across state lines and demand a cut of that sale 4 years after you left. They are essentially claiming equity in your life. This turns residency into a liability that compounds over time. It's like a bad divorce where you have to pay alimony to a state that no longer provides you with any services. If you're thinking about leaving, you need to understand that the exit date matters. If you leave before the law is enacted, you might be safe. If you leave after, you could be tethered to the California tax code for a decade. This is why timing is everything. Reason number 3, the assault on small business owners. California is already ranked as one of the most difficult states to do business in, but this new framework takes it to a new level. If you operate a business in California, or if your business has nexus, the state is getting more aggressive about claiming your income even if you move operations elsewhere. Let's say you are a consultant or a digital creator. You build your brand in Los Angeles. You move to Austin, Texas to save money. California's aggressive auditors could argue that the intellectual property or the customer base was created in California, and therefore, a portion of your future revenue is taxable in California. This is known as source income, and the Franchise Tax Board is infamous for stretching the definition to its absolute limit. For entrepreneurs, this creates massive uncertainty. You move to a business-friendly state to reinvest in your company, but you have a silent partner, the state of California, draining your capital. The smart move is to sever ties completely and cleanly before these new aggressive interpretations become codified into law. Reason number 4, digital nomads are in the crosshairs. You might think that because you are working from a laptop in Lisbon or Mexico City, you are safe. Think again. California has some of the strictest residency audits in the nation. They look at where your bank accounts are, where your doctor is, where your storage unit is, and yes, where you spend your time. Under the new proposals, if you were a resident when you earned equity compensation, like stock options or restricted stock units (RSU), California will tax that equity when it vests, no matter where you are living at the time. If you are a tech worker who left Silicon Valley during the pandemic but kept your California-based equity package, you need to consult with a tax pro immediately. The state is investing heavily in data analytics to track digital nomads who claim to have left but still have economic ties to the state. The exit tax would formalize this reach, making it statutory rather than just a regulatory aggression. Reason number 5, property taxes are becoming a second mortgage. We all know about Proposition 13, which limits property tax increases, but local governments have found a workaround: parcel taxes and bond measures. Every election cycle, voters approve billions in new bonds for schools, infrastructure, and homelessness programs. These bonds are paid for by property owners. In counties like Alameda and Los Angeles, your property tax bill is loaded with these extra line items. On top of that, insurance costs in California are skyrocketing due to fire risk. When you combine high taxes with tripling insurance premiums, the holding cost of California real estate is exploding. And now there is talk of vacancy taxes in major cities. If you have a second home or an investment property that isn't occupied for a certain number of days, you get hit with a penalty tax. They are penalizing you for owning property. If you are holding real estate in California hoping for appreciation, you need to calculate if the rising carrying costs and potential new wealth taxes will wipe out your gains. Reason number 6, the cost of living versus quality of life arbitrage is broken. There used to be a sunshine tax. You paid more to live in California because the weather was perfect and the amenities were world-class. Today, you're paying luxury prices for third-world infrastructure. The roads are crumbling, homelessness is a humanitarian crisis, and crime rates in major metros are driving businesses away. A family earning $300,000 a year in San Francisco is effectively middle class. After federal tax, state tax, which hits 13.3% at the top, sales tax, and the cost of housing, there is very little left to build real wealth. Compare that to Tennessee or Texas. That same income allows for a massive home, private schools, and significant retirement savings. The return on investment for living in California has turned negative for high earners. You are paying premium rates for a deteriorating product. Reason number 7, your retirement nest egg is the target. This is the one that keeps financial planners up at night. California does not tax Social Security, but it taxes almost everything else, including 401,000 withdrawals and pension income. If the wealth tax passes with its look-back provision, it could apply to the retirement assets you accumulated while working in California. Imagine saving for 40 years, moving to Nevada to retire tax-free, and then receiving a bill from California for a percentage of your IRA balance. This fundamentally breaks the promise of retirement planning. You made decisions based on the rules of the game, and now the state wants to change the rules after the game is over. If you have a substantial nest egg, the risk of staying past the implementation date of these new laws is simply too high. Reason number 8, the corporate exodus creates a tax vacuum. Oracle, Tesla, Hewlett-Packard Enterprise, the list of companies moving their headquarters out of California grows every month. When these giants leave, they take thousands of high-paying jobs and millions in tax revenue with them. Here is the economic reality. When the tax base shrinks, the government has two choices: cut spending or raise taxes on the people who remain. California has shown zero interest in cutting spending. In fact, the state budget deficit has ballooned to record levels. This means the tax burden on the remaining residents must go up. By staying, you are volunteering to pay the debts left behind by those who left. You become the bag holder for a fiscally irresponsible government. Reason number 9. Better options are actively recruiting you. It's not just that California is pushing you away. Other states are pulling you in. Florida, Texas, Wyoming, Nevada, South Dakota. These states are creating wealth havens. They have no state income tax. They have strong asset protection laws. They are business-friendly. We are seeing a massive transfer of wealth from blue states to red states. This isn't just about politics, it's about economics. Capital goes where it is treated best. If you can do the same job or run the same business in a state that lets you keep 13% more of your income instantly, staying in California is a financial error. That 13% compounded over 20 years is millions of dollars. It is the difference between a comfortable retirement and generational wealth. Reason number 10, the window of opportunity is closing. This is the most critical point. Laws like the proposed wealth tax and exit tax don't happen overnight, but once they are passed, they often have retroactive effective dates. This means they could pass a law in late 2026 that applies to everyone who was a resident as of January 1st, 2026. If you wait until the law is signed to make your move, it might be too late. You might already be caught in the net. The legislative session moves fast, and with the supermajority in Sacramento, there is very little opposition to stop these bills if the political will is there. The smart money is moving now. They are establishing residency in other states, moving their driver's licenses, moving their voter registration, and moving their primary banking relationships before the hammer drops. So, what should you do? First, subscribe to Tax Hack Pro. We are going to keep you updated on the status of OB 259 and ACA 3. You need to know if these bills advance out of committee. Second, consult with a tax strategist who specializes in residency audits. Leaving California isn't as simple as driving away. You need to sever your ties properly so the franchise tax board cannot claim you never left. We have videos on this channel dedicated to the California residency trap. Go watch them. Third, run the numbers. Look at your net worth, your income trajectory, and your retirement horizon. Calculate what a 10-year exit tax would cost you. Compare that to the cost of moving. The math usually speaks for itself. California is a beautiful state with incredible people, but the fiscal policy has become predatory. It is treating its most productive citizens like atoms. You have a right to protect your family's future. You have a right to keep the fruits of your labor. Don't let nostalgia keep you in a financial trap. The warning signs are flashing red. February 2026 is the potential tipping point. Will you be watching from a tax-free state, or will you be writing a check to the FTB? Let us know in the comments. Are you planning an exit? What is your red line that would force you to move? And if you found this breakdown helpful, share it with your friends and family in California. They need to know what is coming. This is Tax Hack Pro signing off. Stay informed, stay wealthy, and we will see you in the next video.